For nearly 50 years, oil was priced exclusively in US dollars, a system that not only cemented America's financial supremacy, but also shaped the very architecture of global trade and power. The so-called petrodollar arrangement meant that countries around the world needed dollars to buy oil, fueling constant demand for the greenback and reinforcing the United States' central role in the world economy. This arrangement gave the U.S. unparalleled influence, as nations stockpiled dollars and invested in American assets, further strengthening the dollar's dominance and global demand for its currency. But in late 2025, that foundation is shaking. Saudi Arabia and Qatar, two of the world's energy giants, are moving away from the dollar, strengthening ties with the BRICS bloc, and now accepting Chinese yuan for oil transactions. This is a dramatic departure from decades of tradition. This isn't just a financial maneuver, it's a profound geopolitical realignment with far-reaching global consequences. The balance of power is shifting and new alliances are being forged. The old US-Saudi bargain, oil for security, has frayed. The US, now more energy independent thanks to its shale revolution, no longer relies on Middle Eastern oil as it once did. Meanwhile, Saudi Arabia's Vision 2030 seeks to diversify its economy and find new partners beyond Washington. China, now Saudi Arabia's biggest oil customer, offers not just a massive market but also investment, technology and infrastructure, outpacing what Washington can provide in the new era of global competition. Riyadh and Doha aren't abandoning the West but are embracing a multipolar world, skillfully balancing relationships between competing powers to maximize their own influence and security. By joining BRICS and selling oil in yuan, these Gulf states are signaling a rewriting of the old rules, challenging the dollar's monopoly and opening the door to a new era of global finance. Every barrel sold in yuan chips away at the dollar's dominance, threatening the US's ability to borrow cheaply, run persistent deficits, and maintain its economic edge. The shift is gradual but unmistakable. The epicenter is the growing Gulf-China relationship, which is redrawing the map of global commerce and influence. The tectonic plates of global finance are moving, and the world is watching as a new order begins to take shape, one that could redefine the future of money, power, and international relations. BRICS began as a label for emerging economies, a term coined to capture the rise of Brazil, Russia, India, China, and South Africa on the world stage. But today, it's evolved into a powerful coalition, shaping global conversations and influencing international policies. In 2024, BRICS expanded its membership, adding Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. Together, these nations now control nearly 40% of global oil production, a significant share. With Egypt joining, the bloc now influences the Suez Canal, a vital artery for global trade and commerce. This consolidation gives BRICS unprecedented economic leverage, challenging the dominance of Western-led institutions and shifting the balance of power. The expanded bloc aims to reduce reliance on Western financial systems, especially as sanctions increasingly weaponize the dollar and impact member economies. For some members, it's about economic survival. For others, it's a quest for greater strategic autonomy and independence. The new development bank now funds projects in local currencies, signaling a determined push for a more multipolar world order. BRICS is no longer just talk, it's taking concrete action to reshape global governance and redefine the rules of international engagement. Saudi Arabia and Qatar's pivot to China is a strategic partnership, not a passing trend. Both nations are recalibrating their foreign policy, recognizing that the global balance of power is shifting toward Asia. This move is not just about economics, it's about securing a place in the emerging world order and ensuring long-term stability for their people. Vision 2030 drives Saudi Arabia to diversify, and China is stepping in with capital and technology. Chinese companies are investing in everything from infrastructure to renewable energy, helping Saudi Arabia reduce its reliance on oil and build a more resilient economy for the future. In 2022, Xi Jinping's visit to Riyadh sealed $50 billion in investment deals, deepening economic ties. These agreements span sectors like energy, technology, and manufacturing, signaling a new era of cooperation that goes far beyond traditional oil trade. The 2023 currency swap between China and Saudi Arabia allows direct trade in yuan and reals, bypassing the dollar. This bold step not only strengthens financial independence, but also sets a precedent for other countries considering alternatives to the US dollar. Qatar, the top LNG exporter, signed a 27-year deal with China, also moving toward UN-based trade. This long-term agreement guarantees energy security for China and stable revenues for Qatar, while further cementing their economic partnership. Both Gulf states are hedging their bets, joining BRICS and using Yuan to balance East and West. By engaging with new alliances, they're gaining leverage and flexibility in a rapidly changing geopolitical landscape. This is also about de-risking. US dollar sanctions on Russia and Iran have made Gulf leaders wary. They're learning from recent history, seeking to protect their economies from external shocks and political pressure. Diversifying alliances and currencies insulates them from geopolitical shocks. It's a calculated strategy to ensure economic resilience and maintain influence on the world stage. It's a pragmatic move to safeguard national interests in a fragmented world. By forging new partnerships, the Gulf states are preparing for a future where power and prosperity are more evenly distributed. The Gulf's eastward pivot is reshaping global energy and finance, signaling a profound transformation in how nations collaborate and compete on the world stage. The Petro-Yuan directly challenges the petrodollar system that has powered U.S. financial dominance since the 1970s. For decades, oil has been traded almost exclusively in U.S. dollars, cementing the dollar's role as the world's reserve currency and giving the U.S. enormous economic leverage. But now, a new contender is emerging on the global stage. China, the world's largest oil importer, wants to pay in yuan, reducing dollar reliance and boosting its currency's global status. This move is not just about economics, it's a strategic push to reshape the balance of power in global energy markets and increase China's influence worldwide. The Shanghai Petroleum and Natural Gas Exchange is now the hub for yuan-settled energy trades. Here, international buyers and sellers can transact in yuan, signaling a shift in how oil deals are done and challenging the dollar's monopoly. Saudi Arabia, sending a quarter of its oil to China, is under growing pressure to accept yuan. If the Saudis agree, it could trigger a domino effect, encouraging other oil exporters to follow suit and accelerating the petro-yuan's rise. Initial steps are small, but each yuan-priced barrel sets a precedent. Every new contract in yuan chips away at the dollar's dominance, making the petro-yuan more credible and attractive to other nations. The main hurdle: the yuan isn't fully convertible, making it hard for exporters to use globally. Many countries still hesitate, worried about liquidity and the ability to freely move their money. China is encouraging Gulf investments in its economy to create a closed yuan loop. By offering investment opportunities and financial incentives, China hopes to make the yuan more useful and desirable for its trading partners. Russia and Iran already sell oil to China in yuan, expanding the network effect. As more countries join, the petro-yuan's reach and influence continue to grow. The world is moving toward a multipolar currency system for energy, where the dollar, yuan, and others compete. The petro-yuan's rise marks a new era in global finance, with profound implications for the future of energy and international power dynamics. The move away from the dollar is accelerated by digital innovation, especially central bank digital currencies, CBDCs. China leads with its digital yuan and Project M-Bridge, a cross-border CBDC platform. In 2024, Saudi Arabia joined M-Bridge, enabling instant, low-cost international transfers outside the US-dominated system. This new infrastructure lets, for example, a Saudi oil company and a Chinese refiner settle trades in seconds using digital currencies. Chinese banks are also expanding in the Middle East, with the Bank of China opening in Riyadh to support yuan-based trade. These digital and physical networks form the backbone of an alternative financial system. While still small, every successful transaction builds confidence in this parallel system. The new financial plumbing is faster, cheaper, and independent of Western oversight. The era of digital multipolar finance is underway. The 2024 BRICS expansion has made the bloc a resource superpower. BRICS Plus now produces nearly 40% of the world's oil and dominates natural gas, minerals, and agriculture. China leads in rare earths, while Brazil and Russia hold vast reserves, giving the bloc leverage over global supply chains. BRICS nations are also aggressively buying gold, diversifying away from the dollar. In 2023, China added 225 tons to its reserves, part of a broader move to hold more physical assets. This resource dominance gives BRICS real power in pushing for de-dollarization. Their proposal to trade in local currencies is backed by tangible economic weight. The West can't ignore a bloc that controls so many global commodities. Despite these shifts, the US dollar's dominance is far from over. It's involved in nearly 90% of global foreign exchange transactions and remains the default for trade and investment. The depth and liquidity of US financial markets are unmatched. No other currency offers the same security or scale. China's markets are still constrained by capital controls, limiting the yuan's global reach. For the yuan to become a true reserve currency, China would need to liberalize its economy, something Beijing is reluctant to do. The most likely future is a fragmented multipolar currency landscape. The dollar will remain the world's leading currency, but its share will gradually decline. The yuan will dominate within Asia and among BRICS partners. We're entering an era of currency competition, not dollar replacement. The global financial system is evolving, reflecting a more complex, multipolar world.